Well, let's just focus on CNBC TV18 exclusive now. The government officials tell CNBC TV18 that it will be difficult to meet the revised tax targets for FY19. Sapna Das joins in to fill us in with all those exclusive details. Sapna, over to you.
Hi, morning. So basically, the sense that we are getting is that even the scaled-up direct tax target, basically corporate tax around 50,000 crores in the revised estimates of FY19, and the scaled-down version of CGST, there was a huge cut of 1 lakh crores. On both accounts, there are challenges. Clearly, so on the direct tax front, two quick numbers I will share here with you. To achieve this higher number of 50,000 crores, and that's in corporate taxes, the growth rate will have to be at around 19.5%, and currently your direct taxes are growing at a pace of 13%. So there the variation is pretty much obvious, so to speak. Even if you look at the budget estimate, the original 11.5 lakh crore, even on that front, the growth rate is right now slightly below. 14.8 is the asking run rate, and they are around at 13%. So that's another number to keep in mind. Quickly on the CGST front also, despite the scaled-down version, we're getting to understand probably 50,000 crores is how you'll miss the target. But the point here again is that, as usual, government is very clear about sticking to 3.4% fiscal deficit target for FY19, and more or less, quote-unquote, this number is going to be managed.
All right, this number is going to be managed. We will keep an eye out on that. But in the past few weeks, the market has been fraught with worries about the companies with high pledged shares. In our mega exclusive, Shireen Bhan asks Kotak Mahindra Bank's MD and CEO, their Kotak, on what he makes of the situation and what could have been the trigger for lenders to start being cautious on high pledged shares. Here's what he had to say.
The whole debt levels against promoters' shares requires two parts to it. And first, I believe from an underwriting point of view, the system should have been far more cautious, where the percentage of shares pledged by promoters started going up above 50 or 60% of their total shareholding.
When you say system, who do you mean?
The lenders. Therefore, if the total promoter shares is 100, if the pledge levels started going above 50 or 60%, there was much lower cushion for safety. And in many cases, we have now seen that the pledge shares are as high as 70, 80 and 90%. So that is water levels being extremely high. But at that stage, you really need to look at the underlying business. And if the underlying businesses are strong, some of these need to be restructured and refinanced in a much smarter way than what the marketplace has done so far. What has happened over the last 2 years is NBFCs were allowed to finance at 2x cover. There was no such regulation for mutual funds. So mutual funds were lending at 1.3, 1.4 and 1.5x cover. So this arbitrage which happened between NBFCs financing against shares and mutual funds financing at lower margins is the reason why levels of leverage also went up.